Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and today's lesson is all about temporary provisions. And we're making this video in 2024, so these are the temporary provisions that are currently in place for the 2024-2025 tax season that's upcoming. As always, the guided notes are linked in the description down below, so stay engaged, follow along, and complete the activities to see what you learned. All right, with that, let's get into it. So, what exactly are temporary provisions? So, a provision is either an exclusion or exemption that exists for a limited amount of time, which is why they're temporary. And we're going to be going over some of the most important ones for this tax season and for upcoming ones as well. Again, these will change as the tax years go on and on. So make sure to keep up to date with your temporary provisions if you're watching this video in the future other than 2024 and 2025 tax year. All right. So the first type of temporary provision that we're going to be going over today is student loan forgiveness. And student loan forgiveness is eligible for an exclusion from gross income available for student loan forgiveness after 2020 and before 2026. So this provision will be available until 2026 ends, meaning it'll be ready for the 2025 tax season, which we're getting ready to start with. The exclusion for certain employer payments of student loans. Employers may provide loan repayment benefits to employees on a tax-free basis. Under the provision, an employer may contribute up to $5,250 annually towards an employee's student loans. And this payment would then be excluded from the employee's income, meaning they would be taxed at a lesser rate. This applies to both new student loan repayments as well as any additional educational assistance, such as if your employer paid for books, tuition, etc., etc. And higher education emergency financial aid grants. Under the CARES Act, it covers unexpected expenses, unmet financial need, expenses related to the disruption of campus operations. This is all due to the COVID-19 policies, as we're all really familiar with. And this act will be able to have you exclude certain unexpected educational expenses. All right, so the next type of provision we're going to be going over today is debt, or specifically the cancellation of debt. And the way we do this in the Volunteer Income Tax Assistance Program is that we are only able to do an exclusion or an exemption from the cancellation of debt on a principal residence. That's just what's in scope for the VITA program. So if you are a taxpayer looking to receive free volunteer help for your tax return, but you have other debt that is not the cancellation of a principal residence, we might not be able to help you claim an exclusion or exemption. Now, if you've seen my other income lesson, we talk a lot about the cancellation of debt and how that's reported on your income tax return, even if you're not necessarily vying for an exclusion or an exemption. So I encourage you to watch that video after this one to get more information. So before we talk about the cancellation of debt, we have to talk about the two types of debt that you could owe, and that's recourse debt and non-recourse debt. Recourse debt holds the borrower personally liable for any amount not satisfied by the surrender of secured property. This basically means if you owe debt and on, say, your house, that means the person who lended you money to buy the house, they could seize both the house and they could continue to seize personal assets until you have met that debt, which is not very good. Canceled debt above the property's fair market value in a recourse debt foreclosure is treated as ordinary income unless exceptions apply. So this relates a lot back to our canceled credit card debt lesson in the other income lesson, which I will link because it's a really important lesson to understand this. So canceled debt, when you cancel debt, it's acted like you're taking the income. So when you cancel debt, sometimes your lender will be like, oh, you canceled your debt. As long as you paid this certain amount, we'll just say the rest that you didn't pay is on the house. That sort of thing. So canceled debt, when this would be your lender saying, okay, your debt that's on the house, if that number is above the property's fair market value in a recourse debt foreclosure, it's treated as ordinary income, and you'd report it on the income section of your tax return. And the taxpayer may also have a gain or a loss on the property. And this is calculated as the fair market value minus the property's basis. And again, we talked about basis in our capital gains lesson and our other income section. So I encourage you to check that out. All this capital gain loss, it must be reported with the viable exclusions for certain debts, and this will be calculated on your latest tax software that your Vitus site uses. In our case, we use TaxSlayer, and it'll automatically calculate the available exclusions for certain debts. Okay, so now that we've talked about recourse debt, now we're going to go into non-recourse debt. And this is debt satisfied by the surrender of secured property, regardless of the fair market value at the time of the surrender. And the borrower is not personally held liable for the debt. This is where if you owed debt on your house and your lender was like, hey, you owe debt on your house, but the taxpayer was like, I can't pay it. I'm gonna have to foreclose the property. I can't pay my debt. This is where the lender was like, okay, I'll just take the house. That's it. That's my collateral. We're done. You don't have to pay back the debt you still owe. When non-recourse debt property is abandoned, foreclosed, short sold, or repossessed, it's treated as if the taxpayer sold the property. The gain or loss is then calculated by including the non-recourse debt balance at disposition as the amount realized. The borrower isn't liable for the debt, but the difference is seen as the property's fair market value and loan balance. It isn't included on the taxpayer's income. So again, non-recourse debt, it's treated as the sale of the property by the taxpayer. So it's treated like you're selling the property, but it's almost like you're selling the property at a loss because you still have to pay back that debt. You obviously bought it for more than you could sell it for. And an example of this would be a taxpayer, Nicholas, lost his home to a foreclosure because he could no longer make his mortgage payments. At the time of the foreclosure, he owed a balance of $170,000 to the lender, and the fair market value of the property was $140,000. The recourse loan, if he were to have taken out the recourse loan, the selling price would have been $140,000. But if you were to have taken out the non-recourse loan, the selling price would be $170,000. Some canceled or forgiven debts may be eliminated from income by applying an exception, or reduced by applying an exclusion to the general rule. Now remember, exceptions are applied before exclusions. So what are exemptions and exclusions? This is basically a way to lower the amount you're being taxed at, your AGI, by taking these exemptions and exclusions on certain qualifications that you meet. So let's get into that. Exceptions. So these may allow a taxpayer to eliminate the following types of canceled debt from your income. And this includes income exclusions, which include gifts, bequests, certain student loans, etc., and deductible debt. This covers amounts like deductible home mortgage insurance, mortgage interests, etc. So these exceptions were to be if the taxpayer has one of these, it would not be reported on their income. So if they had home mortgage interest that they could potentially deduct, you just take that off their income and it wouldn't be included to be taxed. And another type of exception is a post-purchase price reduction. And this reduced debt by the seller, lowering the property basis if the taxpayer is solvent. And what solvent basically means is you're not bankrupt in terms of personal finances. You're not owing money. You can stay afloat, basically. And now we're going to get into what exclusions are. And exclusions require Form 982 to file, and this form must be filed with the tax return to report excluded canceled debt. Exclusions include debt discharged through bankruptcy, insolvency, qualified farm debt, qualified real property business debt, and qualified principal residence debt. The only exclusion that we are able to do as a volunteer income tax assistance site is qualified principal residence debt. So if you're a taxpayer and you want to claim the qualified principal residence debt exclusion, wow, that's a mouthful. If you want to claim that, then I would recommend seeking help from a professional taxpayer, a tax preparer, as it is a complicated issue and you don't want volunteers messing it up because they're not qualified or trained in this area. Okay. So, the discharge of a qualified principal residence indebtedness. So, how do we get the exclusion for this? Certain canceled debt on a principal residence may be excluded from income, but tax attributes may still need to be reduced by the excluded amount. If a lender takes or the borrower abandons a property, Form 1099A is issued detailing information to calculate gain or loss. Form 1099C is provided for canceled debt, reporting the amount forgiven. On the foreclosure and abandonment and the debt cancellation, if the foreclosure and abandonment and debt cancellation happen in the same year, only Form 1099C may be issued, including 1099A details. Now, what even qualifies as qualified principal resident indebtedness? How can you even claim this exclusion? Well, that's only if your debt is incurred when used to buy, build, or improve a principal residence. And remember, a principal residence is a home that the taxpayer is living in for a majority of the time. It's their main home. It's not a extra home. It's not a ski lodge in Aspen, Colorado that they're just using for their bougie vacation home. No, it's the home you are living in almost all of the time, almost all of the tax year. It's the home that you live in, that you're paying money on. That's your main home. And this debt is also secured by to improve a principal residence that's secured by it, it qualifies. So the debt must be incurred on the principal residence that the taxpayer owns. Refinance debt also qualifies if it doesn't exceed the original loan amount for the residence. The exclusion limit to taking a qualified principal residence indebtedness exclusion is up to $750,000, $375,000 if you're married filing separately. And this is only from 2020 to 2025. So this will become invalid after this tax season. So I will try and update this video for the next tax years when the new rules come out. But other than that, check if you're watching this video in the future, check to make sure that this basically exclusion still exists and the rules are still the same. So the criteria for a canceled principal residence debt, as a VITA intern, we can only assist the taxpayer if the home was never used for business or rental purposes, the debt wasn't canceled due to bankruptcy, the taxpayer is not in bankruptcy when seeking assistance, and Form 1099C doesn't show an amount for interest. The debt for the mortgage was solely for buying, building, or improving the primary residence. So they bought the house, they are still in debt. That's where the debt's acquired. They're either buying it or they tried to renovate the house and they went into further debt. That's where this comes in. Sorry. Okay. Now we're going into foreclosures and capital gains or loss and how to take the exclusions and exceptions for this provision. Now, if a taxpayer defaults on a loan secured by property, the lender can foreclose or repossess the property, and it's treated as a sale for tax purposes. The gain or loss is calculated as follows. Gain is the amount realized minus the adjusted basis, and loss is the adjusted basis minus the amount realized. Gain or loss from a foreclosure must be reported and follows the sale of the residence rules, with the amount realized typically considered the selling price, depending on whether the debt is recourse or non-recourse. So this is basically what we went over before with recourse and non-recourse debt. Taxpayers may also have ordinary income from canceled debt and should then use the worksheet for foreclosures and repossessions in publication 4681 to calculate this and the gain or loss. Hey, Form 1099A or the acquisition or abandonment of secured property. So this form is used to denote the acquisition or abandonment of secured property, and taxpayers usually receive this form and Form 1099-C when their personal residence is foreclosed and part of that debt is canceled. So again, your lender is seeing that the taxpayer is super in debt, and they say, okay, we'll just cancel that some of that debt. If you just pay this amount, that debt is canceled, it's forgiven, it's okay. If the cancellation occurs during foreclosure, only Form 1099-C may be issued. As a VITA intern, you should verify the accuracy of Forms 1099-A and 1099-C, especially the debt forgiven and the fair market value of the property. Advise contacting the lender if there are discrepancies. The sale price varies. For recourse loans, when you're checking the sale price, for recourse loans, it should be the lesser of the mortgage balance or the fair market value. If the taxpayer has a non-recourse loan, it's sorry, my bad. It's the full outstanding debt. Sorry. Losses on the sale of a principal residence generally don't need reporting if the gain is excluded under Section 121, but Form 1099-A recipients should still report the sale to document the property basis. Okay. Sorry. Form 1099-C. This denotes the cancellation of debt. This is also used in conjunction of Form 1099-A, Form 1099-A, which we just went over. So Form 1099-C is something that lenders must issue for canceled debts of up to $600 or more. Taxpayers generally report these amounts on Form 1040, Schedule 1. So as a VITA intern, you'll be reporting this on the income tax return, Schedule 1. That's Form 1040. Taxpayers may exclude canceled debt related to their principal residence if it qualifies, and this is reported on Form 982, which we mentioned a little bit earlier. Form 1099-C shows debtor info, canceled debt amount, and the cancellation date. Bankruptcy indications or interest amounts require consulting a tax professional, as we mentioned. And Form 982 must be filed with the return to report excluded and canceled debt and adjust tax attributes with minimal completion for qualified principal residence debt. Okay. Now we're going to talk about how Form 1099-C works in coordination with Form 1099-A. If a personal residence is foreclosed and the debt is canceled in the same year, the taxpayer may only receive Form 1099-C, which includes the necessary information from Form 1099-A. The gross foreclosure bid is typically viewed as the fair market value, or abandonment or voluntary conveyance. The fair market value is usually the property's appraised value. For recourse loans, the sale price is the lesser of the outstanding mortgage balance of the fair market value. And I promise we're getting to the end. It's a heavy lesson, I know. But now for mortgage workouts and Form 1099-C. Homeowners with forgiven mortgage debt from a loan modification will receive Form 1099-C, and this reports the discharged amount. There's no gain or loss to report since they still own the home. If the canceled debt qualifies as principal residence indebtedness, complete Form 982 to exclude it from the gross income. Taxpayers with non-recourse debt usually don't report income. Usually don't report income from canceled debt unless the lender offers a discount or modifies the loan to reduce the principal balance. Any reduction to the principal due to discounts or modifications is considered canceled debt and must be included in income unless exceptions apply. Finally, how do we report gain or loss on Form 8949 and Schedule D? Well, Form 8949 reports all capital gains and loss transactions, with subtotals carrying over to Schedule D for aggregate calculations. Losses on a personal residence are not deductible, but gains may be fully or partially excluded under Section 121 rules. For reporting guidance on gains or losses, refer to the Volunteer Resource Guide, Tab D, Capital Gains or Losses on the Sale of a Main Home. If you want to learn more about capital gains, make sure to see our lesson in the income playlist, and that'll clarify a lot about reporting capital gains income on your tax return. Thanks, guys, for listening. So, in summary, we covered how to take the exceptions and exclusions for student loan forgiveness and higher emergency financial grants, the cancellation of debt, specifically within the scope of a principal residence, and how to cancel debt and how to report that canceled debt on your tax return. All right, guys, thanks for watching, and I'll see you next time. Bye.